When I say hedge funds are digging their own graves, I'm sure all of you guys 100,000% agree with me. There is very little arguments there. But when I say the MOAS is very close, I'm sure there is a lot of skepticism. And by all means, there should be. But here in this video, I want to go over exactly one, why the hedge funds are screwing themselves with data and proof to support exactly what I am saying. And then the second part of this video is why the MOAS is actually very close. And it ties into, obviously, the first part of this video. So you guys really have to watch the video until the very end to get the full perspective here. And if you do, I think it will resonate with you a lot, and I think you will find a very strong argument here to support what I am saying. If you do not, leave your thoughts down below in the comment section, but make sure you stay till the end because really this whole video is going to be very, very important. And if you guys are new to the channel, my name is TCI and we have two main goals on this channel: to make you guys money and to also provide you guys an open, honest, and transparent opinion, the same level of transparency that I would give my own family, my mom, my sister, my grandma, everybody else in my family, and give that to you guys free of charge. So if that is something that you guys are interested in, staying up to date on what can make you money as well as an honest, transparent opinion, hit the subscribe button, like the video, as well as make sure to leave your thoughts down below in the comment section. So let's dive into this video. First thing I do want to talk about, and this was very interesting when I seen this, and it really sparked something in my brain to start researching this a lot more. And it is this article: hedge fund short sellers reloading after a year in the Reddit crosshairs. Obviously, if you see that title, you're going to click on it. And it is very disgusting what is in this article. No way to put that. It's disgusting in the fact of it's great for us. It's terrible for them. It's great for us. It's disgusting good news. Because take a look at some of this. It says hedge fund short sellers chased into bunkers a year ago by upstart amateurs are marching again. Now, it says 12 months after being targeted by day traders on Reddit's Wall Street Bets forum, professional speculators are furiously reloading bets against a stock market priced as richly as any in 2 decades. First and foremost, I don't know what stock market they are looking at. It's certainly not your stocks like AMC, but we'll get into that in just 1 second. It says their short sales increased at the fastest rate in more than 10 years during the last 5 weeks. Data compiled by Goldman Sachs Group Inc.'s Prime Broker show. That's a better backdrop than if anybody was still in that FOMO, said Liz Ann Saunders, chief investment strategist at Charles Schwab & Co., referring to fear of missing out, complacency, and over-optimism. Nothing to see here. New paragraph: stocks never go down. That's a dangerous environment. Yet again, I don't know what stocks they are referring to because it's obviously not the stocks that they are actively shorting. Keep in mind what we just said, that the short sellers are shorting stocks at a more aggressive pace than they have in over 10 years. What stocks are they shorting? What stocks does Wall Street have on their radar? Stocks that are down 60, 70, 80% in the past 3 months. Take a look at this. Just mind-blowing information here. AMC's short interest, no surprise, at 22.15%. GameStop, 20.98%. And it's very clear. Look at any stock if you have Ortex or any other way to look at the short interest. If you're invested in it, if it's a higher growth company, it is shorted into the ground. Now, there's an argument for shorting high growth stocks in an environment where the Fed is going to have to tighten everything, suck out all of the liquidity that they have pumped into the markets in the past 2 years. But at a certain extent, you start to short stocks that are well under their fundamental valuations. And I think it's pretty safe to say that AMC, even GameStop are under their fundamental value. Now, GameStop is a little bit different, but I think if you add into consideration their NFT platform, which if it's valued at the same multiples as OpenSea, the NFT platform that pretty much everybody knows about, then GameStop would also be considered undervalued. And that's a topic for a whole new video, so I don't want to get into that too much. But even take a look at some stocks that aren't really retail stocks. And this is just to set the precedent here of what is going on and what stocks Wall Street is really targeting. SoFi Technologies. This is a stock that I personally invest in. This is not a short squeeze trade. Not at all. This is a long-term fundamental buy. This stock has went from $25 to $27 at the peak, now sitting at about $13 per share, went as low as $10.50 per share. What is the short interest on the stock? 20%. And this is really, like I said, setting the precedent for a lot of stocks. If you look at really any stocks besides the ones we're going to talk about next, the short interest is extremely high, and the short sellers have pushed these stocks under their fundamental valuations, and that is very important. Everything over time always reverts back to the fundamental valuation. And that's why, and here's some proof for you guys, that AMC is at its fundamental valuation, because AMC has really been sitting around $15 per share for a while now. The stock has seen a bump up in price and actually hit a high of over $20 over the past 2 days. So in between $15 and $20 per share, that's really your fundamental value level for AMC. And if you consider other things that the business is doing, like initiatives into crypto, as well as their AMC On Demand, popcorn, just everything else, you can make an argument that the fundamental valuation is much higher. That's not what I'm trying to do here in this video, just trying to give it to you guys straight. But they're not shorting the stocks they should be shorting. So when a market crash happens, they're not going to be prepared, and they're not going to hedge out their portfolios in the way that they should be. Because like I said, you want to be hedging out stocks that you own. If you own a lot of S&P index funds and you think the market's going to crash, you should short the heaviest concentrations in the S&P 500, like Apple, Microsoft, and all of that. And let me be the first to tell you guys that hedge funds have pressure on their backs by their clients to at least match what the indexes do. If the indexes performed 25% to the upside last year and hedge funds performed 5 or 8% in some cases, even Citadel sitting at 18%, then clients start to scratch their head like, why am I invested in this hedge fund that didn't even return what the S&P 500 did? So that is a rule of thumb. You have to own stocks like Apple and Microsoft that are correlated with the S&P 500 to at least return a return that is somewhat the same as the S&P 500, or you will lose clients. So what I'm trying to say here is that hedge funds are shorting stocks that are already shorted into the ground instead of protecting their portfolios and essentially protecting them against a crash and losing a lot of value. Now, why is this important? Because as we do know, like we've covered many times here on this channel, you really have to see a crash in the markets to see liquidity being restricted to see the MOAS. Yes, you can see short-term rallies like we are currently seeing with AMC, but that's not going to cause the MOAS until shorts are forced to cover. The only way shorts are forced to cover is when liquidity starts to dry up. Let's go back in time to June or even January the first time around when hedge funds were using a lot of leverage to short AMC and GameStop into the ground. Some hedge funds went under, like Melvin Capital, right? Some hedge funds did not. Why did hedge funds not go under? Well, there's a lot of variables here, but as a general rule of thumb, they had a lot of money. They had a lot of capital to service their margin calls when good old broker called them up and said, we need $500 million or $1 billion in your margin account right now, or we're going to liquidate your positions by the end of the day. They said, all right, take it. We don't need it right now. We have plenty of money. Stock market's going up. Does not matter. And you've seen some of the other guys like Melvin Capital say, shit. That's probably what they said on the phone. Couple, curse words. They were not too happy. They were forcefully liquidated and lost 50% of their value in some cases. The hedge funds. So, why, again, is the market crash so important? And why is this so bullish? Because when the crash happens, hedge funds, they're going to lose their ass because they're shorting stocks that are already priced for their worst case scenario. And the way that you guys have to think about this is when the markets go down and they're down for a extended period of time like they will be. This is not going to be a one-day event, so don't worry, you're not going to miss out. Markets, they go down. And they will stay down until the Fed U-turns and starts providing accommodation or even quantitative easing to the markets again. That's when markets will bounce again, right? So the markets go down. Hedge funds are not prepared. They lose a lot of money. So they're at a very vulnerable state where they still have to cover on their short positions, but they don't want to until they are forced to. That's the key here. Everybody knows a stock goes up and then comes back down. That's the cycle of short squeezes. That's the cycle of the markets. So in January and June, hedge funds didn't want to cover if they had money to service those margin calls. They said, we'll wait till the stock goes down. That's what's going on right now. But they are hoping and praying the stock does not rally. The key is when it rallies, when the markets are drained of liquidity, because now that hedge fund that had $500 million or $1 billion for their last margin call is not going to have money for this next margin call when the markets are crashing, because like I said, they did not properly hedge out their portfolios. So then they will be forced to cover by the broker. They will have no choice in the matter. But instead of being 1, 2, 3, 4, 5 hedge funds like in January and in June, it's going to be hundreds of hedge funds that are forced to cover at the same time. I hope this is making sense to you guys, because I think it's pretty straightforward. It's a lot of information to take in at one time, so by all means, feel free to rewind and go over exactly the last couple of minutes of what I've been saying. But long story short, markets go down, hedge funds, they don't have as much money to cover their short positions, and this is proof that they are not hedging out their overall portfolios. They are getting greedy and trying to take advantage of the fear that gets instilled in retail investors when the market does go down. After all of this means nothing if the markets don't come down. But I think it's pretty clear what is about to happen next. We do have an unscheduled meeting for the Fed coming on Monday. It's unclear if we are going to see an emergency rate hike. If that happens, expect a crash to happen shortly after that. If it does not, we are likely to see tightening at the fastest pace we have ever seen tightening, or at least in recent history. What is that going to do? That is going to instill a new level of fear in the economy. And then on top of that, you're going to see the economy start to slow down. Why is that? Because when you give people money for things they did not earn, just give out stimulus checks and unemployment insurance benefits, you just give people money they did not work for, the economy grows a lot very rapidly. And then it contracts just as fast because that money reaches its final destination and does not circulate nearly as much. And that is what we are seeing going on right now. After this tax season, we are going to experience the velocity of money that slows down dramatically. And that is going to cause a slowdown in the economy by the second half of 2022. So your worst case scenario, in my opinion, is seeing a market crash and the economy slowing down by September. By July, September, by midsummer, even late summer, that's your worst case scenario, in my personal opinion. Best case scenario, as far as apes invested in the MOAS, to see a market crash. Does not mean the day the market crashes, the MOAS will happen. We need some kind of catalyst while the markets are down to push AMC up. That's when you get the margin calls. Just because the market drops does not mean that AMC will go through the MOAS. Let me be very clear about that. You have to see a catalyst when the stock is beaten down. A good thing and a good note to pull out of all of this, when the markets crash, AMC has already crashed. So you're already experiencing that pain that you would otherwise have experienced if AMC was at $40, $50, $60, $70, $80 per share. So AMC is not going to come down nearly as much, whereas the broad market will. And that really just sums up a lot more due diligence that can be done on this topic. But I think it's pretty straightforward what is going to happen. We will enter a paper recession. Just like we know, we've covered here on this channel, every time inflation goes over 3.5% to 5%, there is a recession. Every single time. We've covered that many times here on this channel. That is why you want to subscribe to the channel, so you're already up to date with a lot of this information that was said here in this video. But to round it all off, I just want to reiterate yet again that you have already experienced the pain in AMC stock. I have experienced the loss, the biggest loss that we will experience. Why? Because there is a business that is backing AMC and a management team and leadership that is going to prevail. We even seen a tweet from Adam Aaron today. This says, in January, the officially reported short interest in AMC rose by 13.8% from 94.8 million short shares on December 31st to 107.8 million shares on January 31st. I still have an interest in 2.3 million AMC shares, so I hope those short sellers are wrong. Only time will tell. This is unprecedented from a CEO. And he's basically starting beef with the hedge funds that are short in AMC. So all eyes are on notice right now. And long story short, to conclude this video, AMC will prevail and we will all prevail in the end. So that is going to be all for this video. If you guys found value out of it, hopefully education, if not simply just entertainment, hit the like button for me, subscribe to the channel to stay up to date with everything that you guys need to know, as well as make sure to comment down below your thoughts on this video. I think it's a very compelling situation nonetheless. Thank you guys for watching. If you guys want to get some free stock with Moomoo, Webull, and Public, link down below in the description to do so. And if you guys want access and join a great trading community, we have been hitting home runs. The Facebook puts, Snapchat calls, Ford puts, UVXY calls today, SPY puts today. We've been hitting a ton of good trades. Check that out. It pays for itself. Join a great trading community. Get all my trades in real time. Link for that in the pinned comment, as well as my link for the Twitter account. We do some interesting things over there. Keep you guys updated on Twitter. Thank you guys for watching, and I will see you in the next one.